Hey guys, Michael Petrovich Team Home Loan. So in this post, we're going to go over low down payment options in Papillion, Nebraska. So several programs, the FHA, conventional, VA, all have their own low down payment options. First one is conventional just because it has the most options. Um, Conventional has the Home Ready and Home Possible program. So these are 3% down options with discounted MI, which means that even though you're only putting down the 3%, your MI is going to be discounted compared to even a 5% standard FHA, or sorry, standard conventional loan. So if you fit within the Home Ready or Home Possible guidelines, it's an excellent option to get in with just that 3% down. It's not a first-time homebuyer program. You do not have to be a first-time homebuyer to use it, but you do have to fit within their income limits. So you can only make 80% of the area median income. So down below is a link to Freddie and Fannie's website where you can plug in the zip code or the address and see what the area median income is for that area. And your income must be 80% of that. Now, this only counts the person on the loan. So if you're have multiple incomes in your family, only the person that's actually on the loan. So if the husband and wife both working, and one qualifies for the program as far as debt ratios, we can just take the other person off and get you into a Home Possible or Home Ready program. Now, if you don't fit into those guidelines, Freddie Mac has their Home One program, and Fannie has just their standard 3% down program. So these are first-time homebuyer programs. So you're allowed to have as high as income as you want, but you must be a first-time homebuyer. And what a first-time homebuyer means is you cannot have owned a house within the last 3 years at the time we close. So you don't have to be an actual true first-time homebuyer. You just have to have been out of home buying for at least 3 years by the time we close. So those are the two options with conventional. Either you are not a first-time homebuyer but have that income restriction, or you are a first-time homebuyer without that income restriction. So sometimes, obviously, you're going to have too much income and not be a first-time homebuyer. You're not going to fit into that 3% program. We have to look at a 5% down option. If you still need a lower down payment, can't fit in that 5% down payment option on conventional, we can look at FHA. FHA is the original low down payment option. So FHA requires 3.5% down. FHA is not a first-time homebuyer program. You can own a house, sell that one, use the FHA loan right away. You do not have to be a first-time homebuyer to use it. It does not have any income restrictions. You can make as much as you want and use the FHA. FHA is more forgiving on debt ratios and on credit. So if you have less than perfect credit, or even if your credit's just below 700, it might end up that even if you qualify for one of those conventional programs, FHA ends up being overall the better deal. FHA, again, just the standard 3.5% down payment program used by a lot of first-time home buyers because of the more forgiving debt ratios and income and credit to qualify. But anyone can use it. It also allows, and so does conventional actually, also allows gift funds for the down payment. So if you don't have any money to put towards the loan, you can get a gift from a relative for that down payment. And there's ways we document that. Disadvantage of FHA, and I talk about this a lot in my FHA videos, is the mortgage insurance is typically higher, though not always. If your credit's a little lower, it ends up that pushes the conventional mortgage insurance higher, and the FHA ends up being the better deal. The rates are usually lower than conventional, especially at those lower credit scores. But that mortgage insurance never drops off. So once you get 20% on a conventional, the mortgage insurance drops off. On that FHA, it's on there for the life of the loan. Only way to get rid of it is to refinance out of the FHA loan. FHA also charges an upfront fee. So in addition to the monthly MI, you're going to pay a 1.75% upfront fee that goes to FHA. It's not a benefit to you. Mortgage insurance is not a benefit to the buyer. It's just to cover those Fannie, Freddie, Federal Housing Administration in case of default. So that upfront fee is added on top of the loan, 1.75%. If your loan amount is $100,000, they're going to make it $101,750, and that $1,750 is going to go to FHA for their mortgage insurance. The final program is VA. VA is not just a low down payment option, it's a no down payment option. So there's no down payment needed on a VA loan, and there's no monthly mortgage insurance. So VA is a benefit for active military and veterans that meet certain VA guidelines, and that's something we could look up for you. I talk about this a lot in my VA videos, how to use the VA program. If you qualify for the VA program, you probably already know about it. So I'm sure you've probably heard about this. If you're a veteran or active military, they're probably going to tell you that you actually qualify for the VA program now. So when you come in, we can just look that up, get your cert of eligibility, and just verify that. VA is a great program. If you qualify for it, it's probably the best way to go. One thing to consider though is that VA does charge, well, they don't charge a monthly MI, they charge a funding fee. So just like that upfront MI on FHA, there's a funding fee that's rolled into the loan as well. So that could be anywhere from 1.25% of the loan amount to 3.3% of the loan amount, depending on how many times you've used the program and what branch of service you're in, if there's any down payment. Even though you don't need a down payment, it does lower that funding fee. So something to consider, that there is that funding fee. If that's something you're concerned about, we can look at options to avoid that. You might be exempt from the funding fee. So if you're receiving military disability, there's a chance that you are also receiving a waiver on that funding fee. So something we can look at also, that'll be on your cert of eligibility, whether or not you have to pay the funding fee or not. You should know that already. If you don't, not a big deal. We can look it up, very easy to do with some personal information. Another advantage of the VA is what's called the VA IRRL. So it's the interest rate reduction refinance loan. What that is, it's a streamlined refinance that allows you to refinance your loan with no appraisal, very little credit history to document. All you do is document that you're not late on your VA loan. And they really, some lenders do put credit score overlays on there, but they really don't care about credit score. As long as you're just on time on your VA loan, you should qualify for that VA IRRL program. Great to use if the rates are dropping and you can get out of that current VA loan into a new one at a lower rate to save you some money. Very easy way to do that. Okay, so that's the three, actually more than three with conventional, having several options. Programs, if you're buying a house in Papillion, Nebraska, that's my hometown. That's where the office is located. We can help you. We can walk you through these programs either over the phone, by email, or face-to-face. Come in and see us. We'll sit down and go through all of them. So down below is just what to do next. All right, thanks.